Okay, it's 12:11 Eastern Standard Time on September 19th. So, I'm doing this analysis a bit early, so this might change by the time the market closes, but we will find out. At this point, well, we're looking at gold, obviously. The symbol is GLD, and we have an ascending triangle here. And it's a sloppy one, albeit, but still, it's a triangle formation. We have it starting around August 1st and going until today. We do our typical measuring ritual, or whatever you want to call it. Top to bottom, we get a price target, and it gives us a price target of the 200-day moving average. Okay, so you don't like how it's all loose in here, so we'll even bring that in to a closer point of the ascending triangle to give us a preliminary target. Move that one from the breakout point, and it gives us a target about 155, which, does that correspond to any resistance level? Yes, so 155 is our first target. The 200-day moving average is our second, around 100. Let's see, by the time it actually gets down there, and if it gets down there, it'll probably be closer to 150. Now, in my previous post, let's see if my analysis is still up. Yeah, there we go, that big mess of Elliott wave. Yeah, that could make you pretty dizzy. So, according to my Elliott wave analysis, I was making a prediction that we were in a wave 5 cycle, which is an upswing, and a wave 1 primary, which is the first upwards wave of a larger upward wave representing the business cycle. Okay, that was confusing. Let's just say I was guessing that the market's going to go up right now. Easy enough. And it seems that every time that the market goes up, or most of the time, the correlation is actually a little bit negative for gold. So when the market goes up, gold goes down a bit. And this is just in recent times, like since August. And when the market goes down, gold goes up a bit. Of course, it's not perfect, not even close to perfect, but just a slight negative correlation. Like, for instance, as the crash in August started, we see that gold skyrocketed as the market did that. So, anyway, back to my pattern analysis. First, I wanted to make a note that this candle right here, and I'll zoom into the 1-month chart, hopefully it won't be, it's a little big. I'm trying to make it so it's still readable. Anyway, this pattern right here, so it's just a 1-day pattern. It's called a Marubozu. It's a Japanese candle pattern. 1 second while I get the pronunciation. Okay, I'm back. It is called and hopefully I won't butcher this too much. It's called a Marubozu, and it happens when the market opens at near the high of the day, and by the end of the day, it closes very close to the low. There's no tail on the top, so there's no little white line on the top. That's what they call it in Japanese analysis, a shaven head. And if it's on the bottom, it's called shaven butt, by the way. But there is a very small tail at the bottom. Now, according to one of Thomas Bulkowski's studies, and you know how I love his merging of statistics with with technical analysis, which for the longest time was just 100% subjective. He did a study on the most common candlestick patterns to appear before a price breakout to the downside. Sure enough, the Marubozu, or how you pronounce it, Marubozu, was the number one. And it says opening black. That's the specific kind we're looking at. So, it looks like we might have a breakout in gold to the downside in the next few days, or more like tomorrow. So we're looking for a close. Let's see, we're looking for a close beneath about 170, 172.50. and we can feel free to enter after then. Once again, our price target is it's about 150, so $1,500 in gold, and it's tough because it's going to be a counter trend trade, but hey, we'll just make sure to manage our risk. Our stop level. Zoom into the 60-day chart, go to the 2-hour so we can actually read it, and maybe we'll go to the 30-day chart. 30-day, 2-hour. Okay, I can kind of read that. Wow. Commodities gap all the time. So we are going to set our stop loss at $180. We enter the trade at $171.99. So target 150. Stop 180 and a few cents, so 180.10. And we're going to keep doing that trailing stop technique that I told you about in my other post. And our entry, anywhere between 170.150 and 172. So that gives us a, if I can ballpark it if you don't mind, that gives us about an $8.50 risk, conservatively. And a, let's see, target is 50. And actually, I think I'm going to have to adjust this, because if we do that stop level, it's going to hit our risk-reward ratio. So move that down to 177.50, which is going to change that. I want a minimum risk-reward ratio of 3. So we have our stop level at 177.50. There we go. So $5.50 risk, we get in around 172, and then we have about $21.75 reward. Divide the two, we get a risk-reward ratio of roughly 3.85. And since, let's see, ascending triangles, they have a, hold on, my apologies, there's a lawnmower behind me. Ascending triangles breaking out to the downside hit their target about 68% of the time. So once again, just ballparking it, if we take the risk-reward ratio of that, it'll give us a probability-adjusted risk-reward, and I'm doing mental math here, of about 8. And of course, you can do the calculation on your own. I've just managed to teach myself how to do it in a quick flash. Alright, so that is our trade. Once again, it's counter trend, so make sure to manage your stop levels. Alright, happy trading.